Hello, everyone. I'm David Darst. The month of April, after the tough start to the S&P 500 at the beginning of this year, it fell 5% in January, it fell 3% in February. It rallied 4% in March, and now here's April again. The S&P 500 was down another 7%, and the NASDAQ was down another 12%. NASDAQ is down about 24% for the year. That put the S&P down 13% for the year so far. The 10-year Treasury, the 2-year Treasury, and the 30-year Treasury. The 2-year Treasury, 2.63%. The 10-year Treasury, 2.85%. And the 30-year Treasury, 2.92%. There was a lot of selling on the very last day of the month because the day before that, that's Thursday, the 28th of April, you had Amazon and Apple report earnings. We also had the first look at the first quarter of this year, in which it came in at minus 1.4%. The reason was inventory reduction, and secondly, a poor export performance, which you might imagine, given all that's been going on with the international trade situation, tariffs, restrictions, the conflict that's going on between Russia and Ukraine. So you had a fall off in exports by the U.S. So despite the very strong dollar, and the strong dollar also hurts exports, despite the weakness in the exports, the dollar was very, very strong, and the dollar is up over 8% thus far this year. But what happened on that Thursday, the 28th, was Amazon and Apple both reported. And Amazon reported their first quarterly loss in 7 years. You have to go back to 2015 to get a quarterly loss for Amazon. The market interpreted this somewhat negatively in a more broader construct, i.e., if Amazon is having difficulty, does that mean anything about the economy slowing down even further? Apple, as you know, they were talking about the likelihood, because of the supply constraints, particularly in China coming in, the assembly of their various units, that could cost them as much as $8 billion in sales. Now, Apple's numbers were up 9% for the quarter year over year, and the earnings per share came in at $1.52 per share, up from $1.40 last year, which means that's about an 8.6% gain for Apple's earnings per share. But the investors tended to view this in somewhat of a cautionary of both the Apple and the Amazon numbers. We have a strong economy right now in the United States. Europe is slow. Asia is slow. China's in these lockdowns. Japan is sort of somewhere in the middle. Japan is in the midst of a big debate going on with their currency and with their monetary stimulus. So you have, at the same time, a very strong labor market in the United States. You've had, I think it's 9 weeks in a row where the jobless claims have been under 200,000. So that's one thing. Unemployment rate, 3.6%. At the beginning of May, on the first Friday of May, you will get a new look at the April unemployment rate. But the jobs market is strong. Housing market is strong. However, it's showing some signs of maybe slowing down. Now, you've got housing prices. Housing prices are up 20%, 19.9%. The reason for that is the lack of inventory. There's just no inventory. 3 or 4 years ago, you had 3 million houses for sale. Now you've got 900,000 houses for sale nationwide. Second thing in housing is the housing sales, okay? So you have prices up, sales have been slowing because mortgage rates, along with treasury rates going up, mortgage interest rates are going up, and you've got a mortgage interest rate now of 5.6%. That's up quite a bit from below 3% not so long ago, just a few months ago. And finally is housing starts. And as you might imagine, housing starts have been held back by shortages of materials and shortages of labor. Don't forget, we have 11 million unfilled positions in the U.S. economy where people are looking everywhere to try to get workers to help out. Now, the thing we've been thinking about, everybody's fixated now on the May 3rd, May 4th Federal Reserve meeting, okay? They will have a Federal Open Market Committee meeting, and they have already, Chairman Powell has already said, we're going to probably raise rates by 50 basis points. That's already in the market right now. You have another meeting on June 14th, June 15th, and then a meeting after that, July 26th, 27th. Those are the next three meetings. At the May meeting, you can expect a 50 basis point. Some people have been talking about a 75 basis point. And this is one of the reasons that the market's had a difficult April. One of the reasons is the beginning to think about the medicine that's going to be taken. Now, we've pointed out several times that there are really four Federal Reserves. There's the Federal Reserve of interest rates, and they are going up. They've said this. There's the Federal Reserve of quantitative tightening. That's where they're beginning to shrink the size of their $9 trillion portfolio of treasuries and mortgage-backed securities. That is another tightening, and people are wondering, will they say anything at the May meeting about the pace? They've already said they're going to reduce by $35 billion a month in the mortgages and $60 billion a month in the treasuries. So are they going to accelerate this? Are they going to ramp up? Are they going to immediately start out with that rate? Are they going to gradually increase it? The third Fed is the oil Fed. Now, oil at $105 a barrel, which is late in the month of January, is up 40% this year, and that is another form of tightening. And the fourth Fed is the currency Fed. At a dollar up 8% is a very, it is somewhat of a restrictive. It restricts exports. It causes the dollar value of profits earned by corporations abroad to be worth less when they're translated from a weaker currency back into dollars. So this is a fourth Fed. So there are four restrictive Feds going on right now. What are we focused on as we enter the month, the great month of May? We're focused on the Fed, of course. What are they saying? Will they be able to continue tightening monetary policy in an election year where people are going to start screaming when this starts to hit? You're tightening monetary policy into a growth slowdown. We had minus 1.4% for the first quarter. You just heard that. Right now, our preliminary estimate for the second quarter would be plus 1.4%. Not much of a growth in the first half of this year. The second part of the equation here is the Russia-Ukraine conflict. And that has had an effect on energy prices. It's had an effect on grain prices. It's had an effect on global trade. Okay, so here is something that you cannot really predict this one, but it has been weighing on the market. If there's good news there, you could expect the market to rally. If it continues as it is, it would continue to erode and eat away at the market. A final factor that we want you to be focused on right now and that we're focused on is inflation. Not only what will inflation lead the Fed to do, okay? Is inflation peaking? Some people say it's peaking. Some people, it's going to stay high, but will the rate of change begin? Because you're going to compare against last year's numbers, and the rate of change is going to come down a little bit, although it's going to stay elevated in an absolute sense. The last thing is the effect of inflation on consumption. When you have this inflation, food and energy in particular, it is hurting the consumer. So there's where people are beginning to worry about that. Now, we are of the opinion that you need nothing wrong with having some cash, continue this defensive positioning, this focus on value, and among the growth companies, you want to basically be focused only on the high quality ones, not these long projections in the future and low earnings ones. We have highlighted for several years now, private equity is a great, as long as you can find a good sponsor, private equity is a great place to get equity exposure without this tremendous volatility. And in the month of April, we saw volatility gradually increase from 20 in the VIX index to 33 or above as we closed out the month. With that, I would like to wish everyone an Eid Mubarak, and thank you for listening.